Well, the Wall Street Journal reporting that corporations could repatriate as much as $400 billion in earnings and cash from abroad because of the tax deal. Want to bring in Peter Morici, economics professor at the University of Maryland. All right, Peter, $400 billion, where's that money going to go? We're talking capital spending, buyback, dividends, higher minimum wages. What is it going to work out to?
Well, some of it's going to be to pay the taxes that the tax bill requires. Some of it's going to go into investment, but an awful lot of that is going to end up going into stock buybacks. And that is not the evil thing that liberals would have us believe, because if a particular company already has cash on its hands and now has more, giving the money back to the stockholders is where it belongs. They will either spend it or invest it someplace else where cash is needed. A lot of it will get recycled back into the market, but into stocks that, you know, where the cash is needed. And so that's a good thing. I think this is fine. We ought to be paying people for holding stocks. The other thing to remember is dividends aren't great for folks because they have to pay higher taxes on them than they do capital gains. So cash stock buybacks are really where you want to see it.
Now, here's the thing, Peter. Last Tuesday, when FedEx reported their earnings, I thought the thing that stood out was the CEO saying, if the tax bill goes through, we'll be able to put a lot of money into the pension fund. You know, again, this is something you don't really hear from the mainstream media, and they say, well, you know, a handful of people are going to benefit from this. Pension funds have been notoriously underfunded. Imagine the windfall if companies can actually take money and start to fund them for so many people.
That's a good example of what I mean about recycling. If they put it into their pension funds, they're not just going to put cash into their pension funds. They're going to buy stocks and bonds. That's a good thing. That's going to be good for the market. And it's going to be good for keeping the price of capital low so that the firms that need cash can get it and use it and grow and expand, start up, and the rest. It's not necessarily a bad thing when a company that is doing well gives money back to the shareholders because they're investors.
Yeah, I mean, I think we should always begin with the premise that it's their money, right? Just like our money is our money. This whole idea that somehow money is transferred from the poor to the rich with this tax bill, with the big headline over the Christmas holiday was so despicable and dishonest. Let me ask you that $400 billion number, Peter. I've studied the Bush tax cut, the repatriation cut. It was like $340 billion. That was 2 decades ago. That $400 billion seems low to me.
I think it is low, and I think people are underestimating what's going to happen, but it's not going to come in a rush. You know, they have to bring money back to pay the taxes, all right? So that goes into the federal treasury. But the federal treasury is using that money for the tax cut, and it comes back to all of us. But there's also going to be money that simply comes back because it's freed up and no longer will be punitively taxed. That will come back over a number of years. I'm not looking for a huge rush. For example, you know, the Journal has been writing a series of sensational articles where it finds problems the tax cut's going to create. And one of them is it's going to drive the dollar up. That was yesterday's alarmist piece. It's not going to do that because, first of all, $400 billion is not that much money in the foreign exchange market over the course of a year. And a lot of the money that's going to come back is going to come back over time.
Right.
Because there are yields. This money's invested over there. Even if it's in plant and equipment, it's invested in securities of some kind.
Sure. I want to ask you, I want to shift gears a little bit, Peter, because New York Governor Andrew Cuomo is allowing some New York taxpayers to postpone the pain, that's what he's calling it, of the new federal tax overhaul by paying some of next year's local property taxes before January 1st. What's your reaction to that?
I think it's a good idea if you're in a state where you can take advantage of it, simply because those taxes will be deductible this year, but not next year. But watch out, the IRS could reverse that. You know, the IRS doesn't like people on their taxes paying multiple years. You know, paying expenses that cover multiple years. If you're a small business, you know, you can't pay 5 years worth of a subscription and have it count that year. So it's going to be interesting to see if this is widely done, whether the IRS starts to push back on that tactic.
Finally, overall, I mean, you've had a chance now to examine the entire tax bill. It's not a perfect bill because everyone has their idea of what perfection is. But it went through. It's historic. And to what degree should it help our economy and the stock market?
It should boost investment by about 7.5% to 15%. That's a good thing. It'll boost growth several tenths of a percentage point. By the way, each tenth of a percentage point is valuable. The second thing is, even without the tax cut, we were looking at profits for next year that were at least 10% higher. The S&P is not overvalued unless you go to the Shiller Index, which is contrived. If you look at the 25-year average, it's 25, the S&P profit-to-earnings ratio, and that's where we are right now. That's where we were a year ago. Now, you put on top of that a tax cut, and you've got a really hot market. My feeling is the market's going to do very well next year unless there's some unforeseen event that you or I and no one else can really see. But right now, it looks like we're going to have a strong growth year for the economy, and we're going to have a strong stock market.
All right, Peter Morici, thank you very much. Appreciate your time this morning.
Take care.
All righty.